let's take another look on CIT and its apparent bailout by bondholders. I'm joined by Patricia Edwards, a retail analyst and founder of Storehouse Partners, an investment advisory firm. She joins us from Seattle. Patty, good to see you again. And as Laura Lee and Brian Luke have been telling us just a few minutes ago, this CIT story, this has ramifications across a wide spectrum. Tell us why.
Well, CIT is in the factoring business, among other things, and factoring is where they will essentially buy the accounts receivable. It means that they are the grease that keeps retailing going. Otherwise, if you were making, say, zippers, it would take a long time for your zippers to be made, put into garments, get to the retailer, and then you finally to get paid for it.
Right.
It allows the financing to continue. If CIT is to go bankrupt, and they may not, but as you guys have mentioned, it's looking like down the road things are not a certainty at this point.
Right.
It's going to be the weaker retailers and the weaker suppliers that are going to be hit the hardest.
Patty, will CIT curb lending even though it may stay out of bankruptcy?
Well, they have, from what I've heard, they have curbed some of the lending. And when you're facing bankruptcy, of course, what you're trying to do is you're trying to conserve your capital. I don't see this being any different than what we saw in the major banks back in the fall last year, where they cut down on the consumer lending because they needed to conserve the capital.
Talk to me about the bond market participants here, their role in this, and possibly throwing CIT a lifeline. How significant is that?
Well, you know, my understanding is it essentially puts them at the front of the pack. If they do go bankrupt, PIMCO and Friends are going to be right up there, almost like a debtor in possession financing, which means that they become a fiduciary and they actually have a higher claim on the assets going into things. There are some crown jewels in CIT's business that are worth a lot, and then there are some that aren't worth much. It will give them the opportunity to either take possession of those items or to, in turn, sell it off and make some of their money back. And from what I get...
Patty, I'm sorry, we should point out that some of the weaker companies, obviously, they're the weaker retailers, they're going to get hit. But some of the stronger ones, they could be able to find financing elsewhere, correct?
Darwin Lives, yes. The strong will get stronger and the weak will get weaker if this happens the way I think it will. What we will see is we will see these folks like Target, Kohl's, Walmart, they're all going to do fine. It's going to be the folks who were having trouble getting lending in the first place that had a relationship with CIT and nowhere else, that are not going to be able to go out and get that relationship going with Wells Fargo or anyone else.
Right.
And those are the folks that are going to have the issues.
Patty Edwards, the founder of Storehouse Partners, joining us from Seattle. Patty, thanks. Good to see you.